Hello and welcome back. This is the IronFX week ahead report for the 31st to the 4th of February. My name is Angelos. I'm so excited to be here with you today. As always, our week ahead report is carefully put together for the traders that like to be aware and prepared for what the market will offer in the days to come. Among the top characteristics of a successful trader is the hard work of preparation, and this report aims to do just that and can be used as a window for what the following days may look like in the market. Even though the financial markets are extremely broad and cover for a considerable amount of instruments, this report will be focusing on some of the major Forex pairs, including the greenback, the euro, the British pound, the Australian, New Zealand and Canadian dollars, along with the Japanese yen. Gold and energy commodities will also be mentioned in this report. Our main goal is to provide a detailed analysis of all the pre-mentioned markets and subsequently to support traders with accurate information to trade with confidence and, if possible, minimum risk. So we start first with the US dollar. Now, in the past days, according to the dollar index, the USD was lifted to a new 2022 high level. We'll be taking a look at that with our technical analysis. Some of the developments that may have supported this outcome were the FOMC meeting that took place during the previous Wednesday, which displayed a rather hawkish stance by the central bank. In the FOMC statement, it was noted that the central bank will continue to reduce the monthly pace of its net asset purchases, bringing them to an end in early March. In the FOMC press conference, Jerome Powell admitted that the inflation was slightly worse compared to where it stood during the December FOMC meeting. The Fed's chairman stated that the way to counter higher inflation may be to turn the current highly accommodative policy the central bank keeps to a substantially less accommodative one, and over the time to a policy that is not accommodative. Moreover, he added that the fiscal policy that has been supporting the economy for the past years will be turning negative this year. In addition, Jerome Powell stated that the Fed will decide on raising its interest rate in March, but noted this will take place assuming the conditions are appropriate and considering risks. At the moment, USD CHF is heading the list of the strongest major Forex pairs, moving upwards, while USD Jpy and Euro USD also display strength for the greenback. In the following week, the most important economic releases is first the US employment report for January, which is expected on Friday, the 4th of February. The Fed noted it views a strong employment market for the economy, and this event could create waves of volatility for the US dollar. While on the 1st of February, we get the ISM manufacturing PMI for January. And on the 3rd, we get the weekly initial jobless claims figure and the ISM non-manufacturing PMI figure for January. Moving now to our technical analysis, please note this is the USD index. This is the 4-hour chart. Clear upward trend line. This is the new high for 2022. If the price action is to move higher, then we see the R1 being engaged. This is 97.65. Even higher, we keep the R2 98.30 line, which is also imminent. To the downside, if a correction is to take place, we note the S1 96.55 level. Now, this is a level that was tested constantly in December and was the previous high. But in the past days, the price action breached above. So we tend to maintain a bullish bias for the USD index. And I move now to the euro. During the past week, the euro remained rather subtle and shied away from major price action. On a weekly basis, the euro lost ground against the majority of its counterparts, with the only exception being Euro CHF and Euro CAD that remain in positive territory. In the past days, economic data from the Eurozone provided mixed signals and did not manage to impress traders. On the positive side, preliminary manufacturing data from the Eurozone and Germany was on the rise, with the German figures pushing above 60. While the German IFO figures provided confidence overall. During the next week, a plethora of economic releases from the Eurozone will keep traders occupied from start to end. The most significant event is the ECB interest rate meeting coming up on the 3rd of February, where the central bank is widely expected to remain on hold, keeping its deposit facility rate at minus 0.5% and its policy rate at 0%. At the moment, overnight interest swaps imply a probability of 97.79% for such a scenario to materialize. As we know, and according to ECB President Christine Lagarde, the bank will not be increasing interest rates this year and instead plans to provide further stimulus through its quantitative easing program of asset buying. The Eurozone's yearly final inflation rate, which was released in the past weeks, this rate was for December, stood at 5%, and we expect some guidance to be provided on how the ECB views these circumstances. The Euro Forex pairs tend to display sensitivity during ECB meetings, thus we would advise traders to keep a cautioned approach if engaging the markets. Moreover, starting on Monday the 31st of January, we get the Eurozone preliminary GDP rates for Q4 and the German inflation data for January. On the 1st of February, we get the French inflation data and Germany's employment report, both for January, and the Eurozone unemployment rate for December. On Wednesday, the 2nd of February, we get the Eurozone preliminary inflation data for January, while finally on Friday, the 4th, we get the German industrial orders and the Eurozone retail sales, both for December. This is our technical analysis for the Euro. This is the Euro USD 4-hour chart. This is a clear downward movement from the euro. As we said, the euro was weak in the past days. If the currency pair is to follow up on its current downward trend, then the S1 111 could be engaged first. Even lower, we have the 1.1045 as a second support, and our third support stands at 1.0990. A rebound to higher grounds may find the price action moving towards the R1 111.70 and even higher. The 112.25 is our second resistance, while our third resistance, which if engaged could signal that the currency pair is currently changing from a downward trend to a sideways one, is the R3 112.80. But overall, as we said, and according to our RSI indicator below our chart, which is below 30 at the moment, this is an oversold market. That's our opinion. And now we move to the this is a point that we would like to consider to mention: the interest rate decision by the Czech National Bank, which will also be announced on the 3rd of February along with the ECB. So the CNB will be announcing its interest rate decision. CNB has already performed a number of rate hikes during the past year, and at the moment its interest rate stands at 3.75%, which displays the bank's independent policy compared to other central banks. This may also imply the Czech economy is a few steps ahead, with a rather low unemployment rate of 3.5%. Its industrial output being in positive territory, but inflation remaining rather high at 6.6% on a yearly basis. Caution is advised, as CZK Forex pairs may increase volatility during the CNB policy meeting, especially if the bank is in for a rate hike, taking the rate at 4% as expected. So it's expected to hike rates, and that's also for the CNB. Moving to the British pound. So the pound seems to be closing the week higher against against major counterparts like the JPY, CHF, and the euro, but has lost ground against the USD so far. Its best shot remains the GBP CHF and GBP Jpy, which remain in green territory. In the past days, Boris Johnson shrugged off calls for him to resign over allegations of lockdown parties in Downing Street. The pound's muted reaction may be a sign that traders focus more on the economy at the moment. Economic releases like the UK preliminary manufacturing and services PMI figures for January in the past week came out lower compared to previous figures, which may have discouraged GBP traders. In the past days, An interesting report by the Office of National Statistics indicated spending in the UK increased by 2% in the week ending 22nd of January, bringing the level to 80% of that seen in the equivalent week of 2019. So the comparison is basically a pre-pandemic level. Another report by the same source, however, indicated that specific industries in the UK like accommodation and food services are experiencing worker shortages and are finding it difficult to deal with demand. The assumptions we derive from these reports is that even though we are nearing pre-pandemic levels of economic performance, the UK economy is still experiencing difficulties in certain sectors, which allows for further improvement. In the following week, the Bank of England Bankrate meeting takes place on the 3rd of February and definitely stands out as the bank is expected to hike rates, taking the policy rate to 0.5%. At the moment, OIS imply a probability of 91.46% for such a scenario to materialize. Moreover, in the following week, we highlight the nationwide house price rates for January to be released on Monday, the 31st of January. We move now to our technical analysis. This is GBP USD 4-hour chart. Now, GBP USD is very interesting because we see a small bounce of the S1 133.65, all right, and this is enough to consider a sideways motion between the R1 134.65 and the S1 133.65. So this range is critical at the moment, and if breached to the downside, then we could see the currency pair moving towards the S2 132.90, while if a rebound is to take place, then we could see the pound coming back to the R2 135.45 level. Overall, we tend to keep a sideways motion with some bearish tendencies as a bias for GBP USD. And I move now to the Australian dollar. So, on a weekly basis, the AUD has lost ground against the USD but has gained ground against the Euro and the GBP. During the past days, Australia's CPI rates for the fourth quarter surpassed both previous and the forecasted rates. Yet also in the past days, the manufacturing and services preliminary PMI figures came out lower, which may have been rather discouraging for traders. In the next week, AUD traders will be focusing on the RBA interest rate decision meeting, which is expected on the 1st of February. The RBA is expected to keep its policy rate unchanged at 0.10% with the overnight interest swaps, providing a probability of 92.18% for such a scenario to materialize. Most of the market expectations, however, is that the RBA will make a call on its QE program to either be reduced or removed. According to a Reuters poll, Australia's central bank will end its bond buying program on Tuesday, but is expected to wait till this November for its first interest rate hike in over a decade. So that's a Reuters poll. The same report indicates the central bank may acknowledge the need for a rate hike. Moreover, on the 3rd of February, we get the Australian building approvals and the Australian trade balance for December. Furthermore, Chinese economic data in the following days can also move the Australian dollar. So we have a release on the 30th of January in the early Asian session, which is Sunday basically, and this could have an impact on the Monday opening. So we get the Chinese NBS manufacturing PMI and the final Gaixin PMI, both for January. We also like to comment on the New Zealand dollar, and as we move to New Zealand, so NZD traders will have a rather interesting week ahead with the unemployment rate received on the 1st of February along with the labor cost rates all for the fourth quarter. NZD has lost ground against the US dollar but gained against the euro and the pound in the current week. During the past week, New Zealand CPI yearly rate for Q4 was higher than the previous and the expected figure. These rates may force the RBNZ to consider another rate hike in its upcoming meeting on the 23rd of February. We move now to our technical analysis. Okay, we're going back to the Australian dollar, obviously, but we wanted to put a comment in also for the NZD. So AUD USD 4-hour chart, clear downward trend line. Again, the dollar is dominating the scene. So at the moment we see a test of the S1 0.7005 level, and this was also tested back in December. So this is the lowest point currently in January, and this is the lowest point also for the current year so far. If the price action falls even lower, we could see the S2 0.6930 level coming into play. A rebound higher could signal a movement towards the 0.71 level, and even higher we have another resistance at 0.7170, while at the top we have the R3 0.7230. At the moment, we trust our RSI indicator that is just crossing across the 30 level, that we are seeing mostly a selling dominance for AUD/USD. We move now to Canada and the Canadian dollar. So the Canadian dollar seems to be ending the week lower against the strong US dollar and the euro, but is somewhat break even against the GBP. The past days, the CAD and the Canadian economy were in the epicenter of the market as the Bank of Canada remained on hold, keeping its policy rate at 0.25%. During the meeting, BOC Governor Tiff Macklem affirmed interest rates will need to increase to control inflation, and that Canadians should expect a rising path for interest rates, which could be setting the ground for a new start for the economy, but also the Canadian dollar. So this is a straight up confirmation of rate hikes coming up in the near future. In a report released by the BOC, it was noted that the central bank now sees overall economic slack absorbed, while a reference to the Federal Reserve was also made, confirming the BOC is monitoring the economic circumstances in the countries nearby it and could be affected by the strategies that these central banks like the Fed use. So the BOC also confirmed that the ongoing supply constraints are contributing to higher inflation. And looking at the week ahead, Canada's employment report for January is the most important and will be released on the 4th of February. So this is coming out at the same time with the NFP, the US employment report. And also on the 4th, we get the IVI PMI figures for January. On the 1st of February, we get the Canadian GDP rates for November and the Market Manufacturing PMI adjusted figures for January. So we move now to our technical analysis. This is USD CAD's 4-hour chart. Strong upward movement. It hasn't crossed, the RSI hasn't crossed the 70 level just yet, but we see a clear testing of the R1 127.70, which could possibly signal a movement to the R2 128.35, and even higher we see the R3 129.15 coming into play. If a correction to lower grounds is performed, the S1 126.70 may be first engaged, while even lower we note the S2 125.70, and our lowest support for this analysis is the S3 125.10. So USD CAD, we keep an upward bias for its price action so far. And we move to Japan. So the JPY seems to be closing the week lower against the US dollar. USD Jpy was particularly strong today in the European morning, and its JPY has been also weaker against the GBP, while it could possibly finish stronger against the euro for the week. Most significantly, the USD JPY has advanced in the current week, reversing the previous week drop and still gaining momentum in today's European morning, as I said. Also, during today's early Asian session, Tokyo CPI rates dropped, possibly sending a bearish sentiment for the JPY. On the other hand, the preliminary Jibun bank manufacturing PMI for January indicated a marginal increase and reached a total of 54.6. Even though the increase was small, we could say that it is a positive sign at the moment, with demand being on the rise and supply possibly on the low. Thus, the final reading of the same indicator to be released in the following week on the 1st of February can be interesting for JPY traders. Moreover, in the following week, traders have a short economic calendar to work with, as the preliminary seasonally adjusted industrial output rate will be released in the early morning on Monday, and the Japanese jobs market data for December coming up on the 1st of February. And we move now to USD Jpy. So this is clear upward movement in the most recent sessions. Clear engagement with the R1 115.50 level. There was a breach above it, but the price action returned lower. Thus, we kept this as a resistance. Now, if the price action is to move higher, then we see the 115.85 level coming into play, while at the top, the R3 116.25 can also be engaged. Now, these levels right here, the R2 and the R3, were previously seen at the beginning of January, so they're relevant to this month's price action. And as I said, the currency pair remains in an upward movement. A correction lower could send the price action towards the S1 115.05 level, while even lower we note the S2 114.65, and at the end we have the 114.25. RSI indicator remains above 70, implying the buying orders exceed at the moment. And now we move to other events. So we would also like to note upcoming events that relate to the energy market, which was among the top moving sectors in the current week. So if it's moving in the current week, there is a possibility that will follow up in the following week. We leave that open for you to decide. So WTI and Brent oil prices surged to new multi-year price levels and stabilized higher, while natural gas also moved higher and reached a new weekly high. This was in the past days. On the 1st of February, we get the API weekly crude oil stocks, while on the 2nd we get the equivalent data from the EIA, both releases being a potential source of volatility for oil prices. Moreover, the EIA weekly natural gas reserves will also be released on the 3rd of February, and that relates to natural gas. In addition, energy commodity traders should keep an eye on developments between Russia and Ukraine, as they can move prices abruptly if unexpected news make headlines. On a separate note, the Turkish lira may also be in the epicenter of the market's attention in the next week, with the release of the Turkish CPI rates for January expected on the 3rd of February. In the latest daily sessions, the TRY has stabilized against the USD, the Euro, and the GBP, making it interesting to see if it could maintain this stability in the coming week. Finally, the gold market seems to be closing the week on a strong sell-off. Gold prices have been affected by the powerful USD and the hawkish stance of the Federal Reserve that took place in the past days. We have a special report for gold, and you can use that. It was released in the past days. So we would like to say thank you to you for watching this video. We thank you very much for your time and your focus, and we appreciate your participation. If you want, you can subscribe and you can share this video. From everyone here, wishes for solid trading.